Hello, everyone. Welcome. This is Hallie Cloud, and we welcome you to Health Reform Beyond the Basics. Beyond the Basics is a project of the Center on Budget and Policy Priorities. It's designed to provide training and resources to facilitate enrollment in the health insurance marketplace and Medicaid. We provide these resources for healthcare assisters, advocates, state and local officials, and others who help people get and keep their health coverage. The Center on Budget and Policy Priorities is a nonprofit policy organization, and it is not a part of the U.S. Department of Health and Human Services. This webinar is not intended for press purposes either. As always, after the webinar, we'll circulate the slides, a video recording, and any additional resources that are pertinent to this webinar. We'll also post everything to our Beyond the Basics website at healthreformbeyondthebasics.org. And I'll put all of that in the chat as well. Next slide. All participants are muted and in listen only. If you'd like to ask a question, please click on the Q&A icon in the control panel at the bottom of your webinar screen and type your question into the box. We'll be monitoring questions throughout the webinar, and we'll pause twice today for Q&A during the presentation. We definitely may not be able to answer every question asked, but we will have a recording of a record of all of your questions, and we'll use them for guides for future resources and presentations. Also, if your question does not get answered and you really need an answer to it, please email any questions to beyondthebasics@cbpp.org. And once again, everything is recorded and will be available for viewing on our website. So next slide, thank you. In today's webinar, part 1 in our Open Enrollment 10 series, we're going to cover the rules used to determine household size and explain what counts as income when determining eligibility for premium tax credits and Medicaid. Today's presenters are Jenny Sullivan, who's the Director of Health Coverage Access here at the Center on Budget and Policy Priorities, as well as Allison Orris, who's a Senior Fellow on the Health Policy team here at the Center. So now I'll turn it over to Jenny to get us started. Thank you.
Great. Thanks so much, Hallie. So we always start this series with talking about household size and income and how we count those things, because they really are the core building blocks for how we determine what form of coverage someone is eligible for and the level of financial assistance that they might receive. And I'll note before we get into the details that you'll see application screenshots, and we'll talk about some application quirks that are from healthcare.gov. Most states use healthcare.gov, but there are a growing number of states that have their own state-based marketplaces. And while the applications themselves certainly differ, by and large, the overarching marketplace eligibility policies are the same in every state. So if you have a question about whether something applies in your state that doesn't use healthcare.gov, feel free to ask us offline and we can workshop that with you. Okay, well, before we dive in, it's also worth acknowledging, because we're going to start getting way into the details as we always do, that the online application, whether healthcare.gov or a state-based marketplace, really will do the hard work of determining what help a person qualifies for. But understanding how the information that you put in the application affects the outcome will help you explain to those you assist why you need to ask the questions you do when you're helping them. This is especially true for personal information that, particularly for folks who may be applying for the first time, it may not seem relevant, or they may even be taken aback as to why you're asking their marital status. This is all so that you understand why these questions are asked and to help ensure that you get the information that you need to generate an accurate eligibility determination. So first, the application is going to determine Medicaid or CHIP eligibility, CHIP being the Children's Health Insurance Program. And adults in Medicaid expansion states are eligible for Medicaid if they have income up to 138% of the federal poverty level. In non-expansion states, adult eligibility thresholds vary, but are much lower. The median level for adults with children is 40% of the federal poverty level. And this is typically limited to adults who care for a child. Adults that don't have a dependent child, of course, would not be eligible for Medicaid at all in states that have not expanded. Children up to age 18 and pregnant women tend to have higher, or do have much higher income eligibility thresholds for Medicaid. If someone's not eligible for Medicaid, then the application is going to determine their eligibility for a premium tax credit, which I'm going to call PTC through a lot of this, and you'll see that acronym used over and over in our slides. To be eligible for a PTC, someone has to have income above the poverty line. There is no upper income limit. People whose premium for the benchmark plan in their area would be more than 8.5% of their income can qualify for a premium tax credit at any income level. This reflects a change in law that began in 2021 and has been extended through the 2025 coverage year as of recent legislation. Previously, PTC eligibility was capped at 400% of the poverty level. So if you have that stuck in your head, there's a really good reason for that. But the change in recent years has made many more people eligible for financial help with the cost of premiums in recent years. Of course, the dollar amounts for the federal poverty level change every year. For 2023, the poverty line for an individual is $13,590, and for a family of four is $27,750. And then you can, of course, calculate these income levels for a household of any size. In addition to income, the applicant has to have an eligible tax filing status, which we will talk a lot about today, and they can't be eligible for another form of minimum essential coverage, like job-based coverage. We'll talk more about the premium tax credit in our dedicated webinar next Thursday, but we just wanted to get some of the basic eligibility concepts out there for now. So here's a more detailed look at the federal poverty guidelines and income equivalents for 2023. You can see that household size and income factor largely into whether someone's eligible for a premium tax credit and cost sharing reduction. PTC eligibility is based on the federal poverty guidelines in place at the start of the annual open enrollment period. So 2022 federal poverty guidelines are the ones that we'll use to determine eligibility for 2023 marketplace coverage. Once we know a household's income in terms of the federal poverty level, we can determine what their expected premium contribution is. That information, combined with information about the plans available where the family lives, is used to determine the size of the premium tax credit. Since 2021, the expected contribution has been lower because of changes made by the American Rescue Plan Act and extended in August by the Inflation Reduction Act. People with income up to 150% of the poverty line can currently get a benchmark plan. We'll also talk more about those next week at our PTC webinar, without having to pay anything for the monthly premium. And people with income above the 400% of the poverty line, as I mentioned before, who wouldn't have qualified for any tax credit before the American Rescue Plan Act, can now get a credit if their premium for a benchmark plan would be more than 8.5% of their income. Now, that doesn't mean that everyone qualifies for a PTC. As income increases, that threshold for what your coverage has to cost in order to qualify for a credit certainly increases and does eventually phase out for folks with very high incomes. Now, I know these are lots of numbers and you're used to us throwing these numbers at you if you've been to these webinars before, but if you have, then you also know that one of the things we love to do is create some usable desk aids for you to make sense of this stuff so you don't have to hold it all in your brain or even all in your notebook. So we have a handy reference guide that we update every year with some of the most important information about PTC eligibility and tax filing. This is a 2-pager, so print it double-sided, keep it in your binder or on your desk or on your wall. It's really useful. It includes the federal poverty levels for this year and for last year, expected premium contributions by income, employer coverage affordability thresholds, out-of-pocket maximums, tax filing thresholds, and repayment caps for the advanced premium tax credit. Okay, so now we're going to talk about why tax filing status matters. It's not intuitive that it would be related to what kind of health insurance you get until you dig into how all these pieces fit together. And again, important things for you to understand as an assister, but you don't need to be a tax expert. And in fact, an important thing for you to know as a health coverage assister is when to recommend that people work with a professional tax preparer, whether through the Volunteer Income Tax Assistance Program or VITA or another source. So, tax filing status. Tax filing status is important because one of the first questions on the application is the applicant's marital status, either single or married. And you can see on our screenshot here. Seems like a straightforward question. Seems straightforward, and for most people it is, but it's important to know what the different options are and how they affect tax credit eligibility. Some people who are married should actually say that they are single in order to get the tax credit that they're rightfully qualified for. We are not ever asking anybody to say something that isn't true, but it's important to know why there are some workarounds required to get people the assistance they're qualified for. And some people who will say they're single may actually qualify as married when you ask a few more questions. So we're going to take a look at these different definitions. First, single. This is somebody clearly who must be unmarried, but that does include legally divorced. It does not include people who are married but living separately from their spouse. So you'll notice a pattern here with tax filing status. It has little to do with where people live. Second, married filing jointly. This is someone who is legally married and files taxes with their spouse, regardless of whether they're living together or apart. Married filing separately is someone who's legally married but files taxes separately from their spouse, regardless of whether they're living together or apart. And this is particularly important to understand because people who are married and file separately are not eligible for a premium tax credit. Fourth, we have head of household. This is someone who is unmarried or considered unmarried for tax purposes, we'll talk about that, who pays more than half the cost of keeping up the home for a person or people who qualify as dependents. There's also a fifth filing status, qualifying widower, but it doesn't come into play for our purposes. As I alluded to on the previous slide, someone who is married must generally file a joint tax return to qualify for premium tax credits. However, there's lots of exceptions to most rules when it comes to PTC eligibility, and there are 3 exceptions in this case to this requirement, and 2 of which require you to know a workaround if you're in a healthcare.gov state. The first exception is for people who can qualify as head of household. The healthcare.gov application actually asks questions and will appropriately account for this. You don't need to know a workaround. And then the other 2 exceptions are people who are victims of domestic abuse or people who are an abandoned spouse. These people do not have to file jointly with their spouse to qualify for a PTC, but the application itself doesn't really tell you what to do. So you need to know that to help people out as an assister. Also be aware that some immigrants who file Form 1040-NR, which stands for non-resident, cannot file jointly. And so as a result, they may not be eligible for PTC. There is no workaround for this. This is just an eligibility criteria. Also, it's important to remember that even though someone who files married filing separately cannot file for a premium tax credit, they still could be eligible to enroll in Medicaid or to purchase full cost coverage through the marketplace without a PTC. So getting back to those exceptions, here you can see the requirements for when a married person can file as head of household. This is generally somebody who is unmarried and has kids. But the person can also be married and be considered head of household. So it's important to understand some of the basics of this definition so that if someone says they're married but they're not filing taxes with their spouse, you don't automatically select married filing separately because that would disqualify them from getting a PTC. You want to understand whether they may qualify as head of household because that would open the door to them getting a PTC. These are questions like, will you, and you have to actually answer yes to all of them to qualify to file head of household. Will you file taxes separately from your spouse? Will you live apart from your spouse for the last half of the year? Will you pay more than half of the cost of keeping up your home? Is yours the main home of your dependents for more than half the year? And are you eligible to claim the child or children as dependents? So the healthcare.gov application actually asks these questions, and we'll go to the next slide to show you that, so that they can suss out whether somebody really should be or is qualified to file as head of household, and they will get you there on your own. You can explain this to the person as you're helping them fill out the application, but the application is going to take care of this exception. Let's see, and it's again important to understand why the application is asking these questions, because they can get pretty tedious, particularly if you have more than one dependent in the household. We're going to need to build the family relationships between everyone in the household, understand where everyone in the household lives, what address, and these things can start to feel kind of invasive. So it's helpful to have in your back pocket an explanation for why we're needing to ask all these questions. Okay, now let's talk about those other two exceptions to the married filing jointly requirement: victims of domestic abuse and abandoned spouses. So victims of domestic abuse who will live apart from their spouse in 2023 and who will be unable to file a joint return due to domestic abuse can select single as their tax filing status, even though they are legally married. And we've clipped a picture of the help text that people see on healthcare.gov. And as you can see, the fourth exception there, or the fourth explanation rather, is it talks about people who are either a victim of domestic violence or spousal abandonment, and explains that it is okay for this person to stay single, even though we understand that they are currently married. So again, the same is true for people who live apart from their spouse and are unable to locate them after reasonable diligence. These people should also choose single as their filing status, even though they're married. And this particular situation is not common, but you may come across it sometimes. I have certainly had cases in my experience where people have a spouse who doesn't live in the US, for example, and they are no longer consider themselves married, but you need to help them understand what they should answer on the application. So these exceptions are noted in the help text, as I mentioned, and they can only be used for 3 years in a row. Okay, now we're going to talk about determining household size for premium tax credit eligibility. In order to determine eligibility for the marketplace or Medicaid and CHIP coverage, you have to know the household size and the income in order to determine the person's income as a percentage of the federal poverty level, which again loops back to those required contributions if they're eligible for the marketplace. So all of these pieces really do fit together. So determining household size for premium tax credit eligibility is actually fairly straightforward. The household includes everyone who is expected to be on the household's tax return for the coming year. This includes the taxpayer, their spouse, and any tax dependents. These people are included in the household, even if they're not enrolling in coverage. And you sometimes have to ask that question a couple of times. Yes, you need to include them, even though they're not enrolling in coverage, even though they already have coverage. You need to build out the entire household as part of the application. So who counts as a tax dependent? The application will ask if the applicant has any dependents, so you need to know how to help people respond to that question. Again, something that seems fairly straightforward and often is, but can get pretty weedy in certain situations. So tax dependents can either be children or qualifying relatives, although as you'll see, those terms can be a bit of a misnomer. There are specific criteria that must be met for each one. A qualifying child does not need to be the biological or even the adopted child of the tax filer. They can be other family members as well. They just need to meet these 4 criteria. They must be a US resident or resident of the US, Canada, or Mexico. They must live with the tax filer for more than half the year. They must be under age 19 at the end of the year, or if they're a full-time student, they must be under age 24, or if they're disabled, they can be of any age. And 4th, they can't provide more than half their own support. That's a qualifying child. Now, one situation you will likely encounter is how to count children of divorced or separated parents. The parent who claims the child as a tax dependent is the one who must claim the premium tax credit for the child. Usually, this is the custodial parent. This is true even if the non-custodial parent is the one legally responsible for insuring the child. Now, there is an exception or sort of a workaround to this. If the custodial parents complete a tax form, it's Form 8322, stating that the non-custodial parent will claim the child as a dependent on their taxes, then the non-custodial parent will also claim the premium tax credit for the child. And sometimes this is part of divorce settlements. Now, that's one kind of dependent. The other kind of dependent is a qualifying relative. This is a broad group that can include relatives as well as full-time members of a tax filer's household who are not relatives. The criteria for claiming someone as a qualifying relative, and so for including them in the household, are very strict. First, they can't be a qualifying child, start there. Then they must be a US resident or resident of the US, Canada, or Mexico. They must receive more than half their support from the tax filer. They must be related to the tax filer or live in the tax filer's home all year, all 365 days of the year. And they must have gross income less than $4,400 in 2022. So let's work through a quick example here. We have Amber. Amber is 24 years old. She lives with her parents. She does not pay rent. She doesn't currently have any income. So can we claim her, can her parents claim her as a qualifying child? First, we need to determine if she can be claimed as a qualifying child, and then we'll work our way through the other dependent category. So pretty quickly, when we run through that list, we see that she doesn't pass the age test. She is 24 years old, so she's not under 19. She's not a full-time student, so we can't even get her a few extra years for that threshold, but she's 24, she's not under 24. So even if she were a full-time student, she wouldn't count as a qualifying child in this case. But now we need to ask, could she be considered a qualifying relative? As you can see, we know we've already determined she's not a qualifying child, and she does meet the other 4 criteria to be claimed as a qualifying relative. So her parents can claim her as a dependent on the marketplace application. So remember, the application is going to ask seemingly simple questions, but knowing this background tax knowledge will help you ensure you get the right answer. Okay, so let's work through another example, a little different this time. We have Jay and Kim, and they live together in North Carolina, which is a non-Medicaid expansion state, and they're not married. Kim expects to earn $25,000 in 2023, and Jay is self-employed, he's a musician, he expects to earn $4,200 in 2023. Now, can Jay be claimed as a dependent by Kim? Well, Jay is an adult, so he's not a qualifying child, that's easy, but he receives more than half his support from Kim. They live together all year, and Jay expects to earn less than $4,400 next year. So he is a qualifying relative. Kim can count Jay as a dependent on her marketplace application. And you can see they don't have to be related. They are not married. He can be claimed as a dependent. Okay, so these are the core concepts for figuring out household composition for premium tax credits, but I am now going to turn it over to my colleague Allison to talk about household composition rules for Medicaid and CHIP.
Thanks, Jenny, and thanks to all of you for joining today. And relative to what Jenny just described, there are some important variations when we consider households and eligibility for Medicaid purposes, and specifically modified adjusted gross income Medicaid. And these differences are important to understand so that you can both explain results when you're working with clients, and in some situations, people may want to screen applicants before they submit an application, because if somebody is eligible for Medicaid, you may want to use the state's Medicaid application online rather than starting with healthcare.gov. So let's go to the next slide and dig into this a little bit. And Jenny, I'm not seeing the slides moving. Oh, there it is. So when we're talking about MAGI Medicaid, again, modified adjusted gross income, not everyone's eligibility is determined by the MAGI rules. MAGI rules in Medicaid apply to children, pregnant women, parents, caretakers, relatives, and adults in Medicaid expansion states. This is in contrast to other rules, commonly referred to as the non-MAGI rules, that apply to seniors and people with disabilities. And it's important to know that there are different rules for household and income counting that apply if you're dealing with seniors and people with disabilities. We're not going to go into those in as much detail today, but want to just make that distinction. And overall, states do have a lot more flexibility in the non-MAGI rules, but states also have a couple of options that affect how they determine households, even for MAGI Medicaid populations. So this is definitely a complex area, and we'll walk through a few examples in a couple slides. Let's go to the next slide. So overall, I think a key concept is that Medicaid and CHIP households are determined based on a person's family and tax relationships, as well as their living arrangements. How people file taxes and who is in their tax unit don't always determine who's in their Medicaid household, but it does determine which Medicaid household rules will apply in determining the household. So overall, there are three categories of individuals that people will fall into, and then that category will determine their household size. The first category is the most straightforward: tax filers not claimed as a tax dependent. Typically, this applies to parents or other adults that are a head of household. Second, we have tax dependents. This can be somewhat straightforward, but there are three important exceptions that complicate the category, and we'll talk about those in a couple minutes. The third category is non-filers who are not claimed as a tax dependent. This category reverts to more traditional Medicaid household rules that some of you might be familiar with. And I think in all of this, what's important to remember is that there's a separate determination for each individual in the household. Medicaid is going to look at the individual and who is in the individual's household, and then bring in the income of the people in the household. This will get more clear as we talk about some examples. So even for people who are living together and are related, they might have different household sizes. And also, just an important reminder that this is based on expected tax filing status, not what a person filed last year, but what they expect to file this year. Let's go to the next slide. I'm going to talk a little bit about the details of each of the groups that I glazed over before. And you can see that this slide includes a link to a PDF version of the chart that may be a helpful resource, and we will be sending the slides out after the presentation. So to start with tax filers not claimed as a dependent, the household in this case is the tax filer and the spouse filing jointly, and all the people who the taxpayer expects to claim as a dependent. So if you have an adult and two kids and the adult files the taxes, the adult household will be themselves and the people that they claim as dependents. In the next column, the tax dependent, if you're claimed as a tax dependent on somebody's tax return, then your household is the same household as the tax filer claiming the individual as a dependent. This will mirror tax filing rules. But as I said, there are some exceptions to the tax dependent rule. First, the tax dependent for tax filing purposes is not a child of the taxpayer. In that case, for example, there might be an older adult living with an adult child. Then the adult child doesn't follow typical rules. Another exception is for individuals under 19 living with both parents, but the parents are not expected to file a joint return. If there's a child where the parents are not married or are not filing jointly, you would not go with the typical tax dependent rule. And third, we have individuals under 19 claimed as a tax dependent by non-custodial parents. For example, you could have a child living with one parent, but a different parent is claiming them on their taxes. If someone falls into one of these three exceptions, then we go to the third column and the third set of rules. For non-filers and non-dependents, first, for individuals age 19 and above, the household is the individual plus, if they're living with an individual, the household would include the spouse and children under age 19. For individuals under 19, the household is the individual plus siblings under 19, parents, including step-parents, and children living with the individual. This third column is complicated, but again, it might be a little bit more like traditional rules that applied pre-ACA. And again, we'll make sure you all have this chart, which can be a helpful resource in charting this through. Let's go to the next slide. This too is another resource to try to bring some order to these rules. This flowchart helps by walking through everything and giving you a framework to ask some of these questions. You can start by asking if the individual expects to file taxes, and then also if they're going to be claimed as a dependent on another person's tax return. Those two questions can route you through the various considerations that I just walked through. And again, we have a link to the printable PDF version of the chart that will be available to you. And this can be useful for some of the more complex household scenarios that you might encounter. But let's apply the rules to a couple of examples, starting on the next slide. Here we have a 3-generation household. We've got Sonia, Kyla, and Diane. Sonia lives with and supports both her 60-year-old mother, Diane, and her 7-year-old daughter, Kyla. Sonia's the tax filer, and she's going to claim both Diane and Kyla as tax dependents. At the bottom of this slide, we can see how we have to look at each individual to determine the Medicaid household for each person. And just looking quickly at the numbers, you see that they have different household sizes for Medicaid purposes, even though they all live together. This slide, let's talk about Sonia. We'll apply the tax filer Medicaid household rule. She's the tax filer, and we include spouses and dependents on the tax return. Since she's claiming both Kyla and Diane, we include them in the Medicaid household, and Sonia's household size for Medicaid purposes is 3. Let's go to the next slide. For Kyla, we're going to apply the rules for the tax dependent, and she doesn't fall into any of those exceptions that I just mentioned. So Kyla is a tax dependent, and she has the same Medicaid household size as the tax filer who is claiming her, which here again is 3. And then on the next slide, we're going to talk about Diane. Diane is Sonia's tax dependent. That's that second column of the earlier slide, but she falls into one of the exceptions because she's not Sonia's child or spouse. And therefore, Diane is treated as a non-filer. And if we look at her as a non-filer, we include in her household herself and any spouse or child living with her. Sonia may be Diane's daughter, but Sonia isn't a child. And that's why for tax purposes, Diane's household size, for Medicaid purposes too, is just 1 person. Let's go to another example to see how this works. In this example, we've got non-married parents with children. So Dan and Jen live together with their 2 kids, Drew and Mary. Dan and Jen both have income and they are not married. So on their tax returns, Jen is going to claim the children and Dan is going to file on his own. Both Dan and Jen fall under the tax filer rules for purposes of Medicaid household size. Again, remember that the household includes the tax filer and the spouse or dependent on their tax return. So Dan is a filer, but he's filing alone. Therefore, his household size for Medicaid is just 1. Jen is also filing taxes. She's claiming the kids on her return, and her household size for Medicaid purposes is 3. And again, this is important because they're not married, and that's what helps us get to the 3 for Jen. Let's go to the next slide. When we look at the kids in this family, the kids are tax dependents, but then they fall into one of those exceptions I talked about. They're children living with both parents who don't expect to file their taxes together. So here we'll use the non-filer rules as they apply to people under age 19. And we count the individual as well as their siblings and both parents. For Drew and Mary, we count both of their parents in the Medicaid household as well as their sibling, which means that they both have a Medicaid household of 4. So hopefully those 2 examples help to put a little bit of framing around the general rules. And with that, I'm going to turn it back to Jenny.
Great, thanks, Allison. Hallie, did we have any questions that we should get to right now?
We do. We'll ask a couple. You guys have phenomenal questions. I know that there's a lot of questions, so you are always welcome to email us too. We're definitely not going to be able to get through all of these, and I know a lot are there's a lot of tax rules in this. But we'll answer a few questions now. So first for you, Allison, with the slide 25, the Medicaid and tax filing, is it true that tax filing is not required for Medicaid? So there's lots of people who have low income who haven't filed taxes in the past and don't plan to file taxes this year. Do they need to qualify for Medicaid?
That is a really good question. And you're right, there are plenty of people with very low income who do not. And Jenny, I don't know if you can help me out by sort of explaining how the process works differently. But I think that some of these household rules, it may be helpful to ask some of the questions to understand what the household looks like nonetheless.
Right. I don't have any more to add to that, but that is right.
Awesome. And then going back to some of the tax rules, for the special exemptions or exceptions on married filing separately, but you can still get a premium tax credit. So the domestic violence or abandoned spouse, what documents, if any, are needed to prove this, and will they be asked for by the marketplace?
That is an excellent question. And I believe that these are attestations that do not require further documentation, but I would want to take note of whomever asked that question, which we'll do offline, and I can confirm that.
Oh, perfect. And then if a person has a partner, so I'm assuming by partner we mean an unmarried partner, or not legally, not, I can't remember the tax term. Anyways, a partner where you're not married or in the other arrangement, sorry. Does that partner's income count for the applicant's income on the application?
That's actually a really good segue to talking about what counts as income, which maybe this is the right time to move to that. You tell me, Hallie.
Yeah, that sounds good.
Go there. Okay.
Yeah, and we'll answer more questions at the end too. So keep typing them in and we'll answer as many as we can at the end.
I promise that was not a dodge. Hopefully this will become clear as we work through some more slides here. But what we've talked about so far is how to build these households for PTC and for Medicaid eligibility. But this is important because it's the foundation for whose income is counted. Now we have to get into which income sources are counted for each person and how. Let's see if I can get. Okay, so the most obvious starting point for building income is the income somebody reports on their taxes, their modified adjusted gross income, or MAGI. So this is what we use to determine eligibility for PTCs and for many Medicaid categories, as Allison mentioned. And what you can see on this slide is how we modify adjusted gross income to get to this MAGI figure. So you start with adjusted gross income, which is the income on the tax return. And this is the sum of all the sources of income. Then we're going to modify it by adding a few non-taxable sources of income. This includes non-taxable Social Security benefits. There's a portion of Social Security benefits that are taxable, but this brings along the rest of the Social Security benefit. And then we'll also add tax-exempt interest and any excluded foreign income. These last two categories are pretty rare. You're not going to come across too many people with these sources of income, but if they did apply, you would need to include them to get to the person's MAGI. So in general, when you're asking someone about their income, keep in mind that all income is taxable unless specifically excluded by law. So go in with the assumption that the income is taxable unless you have a very specific reason to know otherwise. So we've got some examples here of taxable income. Of course, wages and salaries and bonuses, those are fairly straightforward, as well as self-employment income, but some Social Security benefits count as taxable. Unemployment compensation, people are often surprised to learn that this is taxable, but it is, as well as most retirement distributions. And those are just some examples. There also are types of income that are specifically excluded from taxation, including things like veterans benefits, cash assistance, child support payments, workers' compensation, and supplemental security income. Not to be confused with Social Security income, which has a similar acronym. So be sure that you're being very specific as you're asking these questions. So a few other things to keep in mind here. Pre-tax deductions like retirement contributions are not included in MAGI because they're not included in wages. And alimony is not counted as income by either spouse. So, general rules about counting income. Keep in mind, income can come in the form of money, goods, or services. You need to assume that everything is included. No matter what people may tell you about what cash they're receiving, maybe they haven't declared it before, or it's a side job, it's a cash-only job. For purposes of the healthcare.gov application and marketplace eligibility, we need to be counting all the sources of cash. It's not to say that what they're telling you might not be true. It probably is true, but for healthcare.gov purposes and for marketplace eligibility, you need to be counting all cash income. So what about self-employment income? This can get tricky. It's just a little bit more complicated, especially because while projecting income can be complicated writ large for any client, it can be particularly hard for somebody who is in a self-employment situation. So the most helpful thing is really to break it down rather than expecting them to have a number at the top of their head. There are a few ways you could do that. You might want to focus on monthly income to get a sense of seasonal expectations for jobs, or maybe they are anticipating a big job that's coming up. Maybe they're a contractor and they know they've got a big build coming up around the corner. You might consider adding or subtracting from the prior year. Do you think you're going to do better or worse than you did last time around? Or you might pull together things like invoices, receipts, or bank records to try and build a reasonable estimate of what their income might be next year. Now remember, with self-employment income, their expenses are deductible, so you can subtract any expenses directly from income to come up with their MAGI. Estimating expenses can also be tricky. You can ask some questions to get a sense of what their regular monthly expenses are for their business. You can look at what happened last year. Again, you can ask, do they rent, lease, or have any repair expenses for some particular equipment they use for their profession? Those are good ways at getting at this. And remember, we're looking for an estimate. This does not have to be perfection. It probably won't be. And there are opportunities to come back and update income over the course of the year. And that's always something that we recommend assisters encourage folks to do. Good news, we also have a tool that can help you with estimating self-employment income. Sometimes it's helpful to have a worksheet so you and the person you're helping are all on the same page. You can use this to come up with what you put into the application, but it's also a helpful resource to send home with someone so that they understand how you built their income, and so they understand how what the starting point is, so that if things change significantly throughout the course of the year, they know that it might be time to come back and see you and to get help updating their income information on the application. So we've dealt with the filer's income. Now we need to enter dependent's income in the application. Now MAGI includes not just the tax filer's income, but the dependent's income as well, if the dependent is required to file a tax return. That may seem straightforward, but in fact, determining when a dependent has a filing requirement can actually be pretty complicated. So we're not going to get into the formula. But if they do not, which is the case for most dependents, then their income wouldn't be included. Because it's so complicated, fortunately, healthcare.gov is programmed to determine whether the dependent's income is counted. So you enter their information into the application, and the application figures out whether it gets counted toward their income or not. So let's work through a quick example here. We have Jill and Ryan. Jill's Ryan's mother, and she claims him as a tax dependent. Her income is $27,000 a year, and his income, he has a part-time job, and he made about $3,000 last year. So whose income is counted for premium tax credit purposes? Well, we know Jill's is included because she's the tax filer, and Ryan's income's probably not counted because it's pretty low. Nevertheless, we're going to enter both of their incomes in the application on healthcare.gov. Now, if Ryan's income was higher, maybe it was above the tax filing threshold, it would be less clear whether it was counted or not, and the application would sort that out for you. But we're going to include it no matter what. In this case, His income is low enough that we're only counting Jill's income ultimately to make a determination for PTC. With a household size of 2 and an income of $27,000 a year, that sets their federal poverty level at 147%, making them likely eligible for, making Jill likely eligible for a PTC, and Ryan's probably eligible for Medicaid and CHIP. So now we need to talk about annual versus monthly income counting. Medicaid and CHIP eligibility is based on monthly income, while PTC eligibility is based on annual income. So the application will ask about monthly and annual income. You're going to enter the type of income, the employer, and how often the person gets paid that amount. If you're entering hourly, which may often be the case, you're also going to enter the number of hours worked for the month, for 1 month only. Then, like in this case, we can see Maria. We've said she has a job, she gets income from a salary or from wages. This is her employer's name. She gets paid $15 an hour, and that's hourly. So after that, the application is going to ask how many hours Maria works per week. So for PTCs, eligibility, as we said, is based on projected income. So healthcare.gov is going to start by taking that monthly income amount that we entered for Medicaid eligibility and multiplying it by 12 to come up with an estimate for projected annual income. For most people, that's probably not going to be accurate, particularly for folks like seasonal workers or people who have monthly patterns to their jobs or wages. So the application will ask, is this correct for a yearly income amount for the person for 2023? You're going to answer no. Then you'll have a chance to describe the projected annual income more accurately. Don't go back and say, oh, that amount's not right. Let me go back to that first question about monthly income and adjust it so that it eventually calculates an annual income that feels more accurate. The application is taking all of these inputs in for a reason, and it needs an accurate monthly income amount so that it can determine if the person is potentially eligible for Medicaid. When you select no, that income is not the correct yearly income for the person in 2023, you'll then be asked if their income is hard to predict. And if you say yes, you will get links to a couple of tools that can help you calculate income a little more easily. Let's talk about those. So the first tool is an annual income calculator, and this is available through the application, or you can go to it directly at the link on the page here. And you're going to enter the type of income, the amount of income, how often they receive it. And you can enter for as many, maybe they have multiple jobs, they have one job that's salary and then another part-time job that's more sporadic. You can enter all of that. You can enter things like unemployment income, all kinds of things. And that way you can adjust for how the system would otherwise estimate income just based on that monthly amount. At the end, it's going to generate a number that you can enter for annual income that should be more accurate. You can also use this tool to print out a PDF with that estimate, again, to send home with the consumer or to get to them so they understand how we got to that number that was on the application for their income, and so they can understand that as their situation changes over the year, if it does, how they can come back and update their application to accurately reflect their current income. The other tool is if you just want to build income by month, maybe we don't need to go by source, we just know that there's going to be several months that the person's either not going to be employed or has a very different income. You can build it out that way. This doesn't create a PDF the way the other tool does, but it does give you an annual number that then you can use for your annual monthly income or your annual income projection, excuse me. Okay, so usually these two sets of rules, using monthly income for Medicaid and annual income for PTCs, results in a definitive eligibility determination. Each person in the household qualifies for one or the other. But there are also times when someone would be determined eligible for neither. Fortunately, there is a rule that makes sure that this doesn't actually happen. This is often called the special rule or the gap filling rule. So let's look at an example here. We've got Carla, who lives alone in a Medicaid expansion state, and she starts a seasonal job at a ski resort this year. So in November, she applies for coverage at healthcare.gov and provides this income information. Her November income, she's just started this job, her monthly income is $1,600, which equals 141% of the federal poverty level, which would be too high to qualify for Medicaid as a single adult. She projects her 2023 annual income, however, to only be $13,000 because the job she has now is seasonal. And after that, maybe she's going back to school or the job is just done. And so $13,000 a year would equal 95% of the federal poverty level. That's too low to get a premium tax credit. So what we do is apply in this situation the gap filling rule, which says that when monthly income is too high for Medicaid, but annual income is too low for PTCs, we'll apply the marketplace household and income counting rules. So based on annual income, Carla is going to be eligible for Medicaid. We'll use the marketplace household and income rules and take her income of 95% of the federal poverty level and see that she, based on that, would be eligible for Medicaid. This rule is one that often trips me up, so I just want to underscore that the gap filling rule says to use the marketplace household and income rules. It doesn't say make the person eligible for marketplace or PTCs. So just be sure to reference that in whatever way helps keep that clear for you. So once all of the relevant information has been entered into the application, healthcare.gov will make a preliminary Medicaid eligibility determination. If they think that somebody is eligible for Medicaid, then the case will be sent to the state for a final determination. The Medicaid agency might agree and say, yep, that person looks like they're eligible for Medicaid, we're going to get them enrolled. Or they might disagree with that initial assessment that the marketplace made and send the applicant back to healthcare.gov. And when this happens, the marketplace is going to send the person a notice telling them to resubmit their application. And these transfers of applications back and forth between the marketplace and Medicaid agencies can take some time. So it would not be unusual for the open enrollment period to have ended by the time the person receives this additional notice. They think they're getting into Medicaid and then they get a notice in the mail in, say, late January, early February saying, no, in fact, you are not eligible for Medicaid. By that point, the open enrollment period has ended, but fortunately, when the person goes in to update their application, they're going to be asked if they were recently determined ineligible for Medicaid or CHIP. And they'll want to answer yes, because that will trigger a 60-day special enrollment period for marketplace coverage so that they can still ultimately enroll in marketplace coverage for the year. So the notice that you see here, the screenshot is actually for 2022, but we expect next year's version to look pretty similar. Okay. We're in the home stretch here, just a couple more examples to show all of this in action, and then maybe we'll have time for a few questions. I know we're running long today, but let's revisit our 3-generation household that Allison walked us through before, Sonia, Kyla, and Diane. Sonia is the tax filer, and she's claiming her daughter, Kyla, a qualifying child, as well as her mother, a qualifying relative, as dependents. How are we gonna use all of these inputs to figure out the coverage that each of them qualify for? Well, we'll start with Medicaid eligibility. Sonia and Kyla will have a household size of 3 using Sonia's income. So remember, we're looking at monthly income for Medicaid. We'll take Sonia's annual income of $35,000 and divide it by 12 to get $2,916 a month, which equals 152% of poverty. Sonia will not be eligible for Medicaid since her income is greater than 138% of poverty, but we know that children's eligibility is much more generous. So with an income of 152% of poverty, Kyla will almost certainly be eligible for either Medicaid or CHIP. Now for Diane's Medicaid eligibility, she will be a household of 1 because we're following those non-filer rules that Allison outlined earlier. Her monthly income is only her own earned income, which equals just 22% of poverty. Now, she may or may not be eligible for Medicaid depending on the state that the 3 of them live in. So we already know Kyla is almost certainly eligible for Medicaid or CHIP. We don't need to look at her for PTCs. But for Sonia, looking at PTCs, we're going to look again at her projected annual income. She's a household of 3 and a projected annual income of 152% of poverty. So she would be eligible for PTCs. Then we look at Diane. We have to change her household size here for calculating PTCs because now she is a dependent of Sonia's in Sonia's household. So her income is the same as Sonia's, $35,000 a year. Now, if she's in a Medicaid expansion state, she would be eligible for Medicaid since her income for Medicaid purposes is only 22% of poverty. But if she were in a non-expansion state instead, she would be eligible for a PTC. Okay. And so we can see where things land there. Last example. Back to Dan, Jen, Drew, and Mary living together. So for Medicaid purposes, Dan will be a household of one. His monthly income is $1,667 or 147% of poverty, so likely not eligible for Medicaid. Jen's household for Medicaid will be three, herself and the kids, with her income, which takes them to 113% of poverty. Her eligibility for Medicaid will depend on whether her state has expanded or not. Drew and Mary will be in a household of four, including both parents, for Medicaid eligibility. Their income includes both parents' monthly income, which added together is $3,834 or 166% of poverty. And this means they are both likely eligible for Medicaid or CHIP. Now moving on to PTC eligibility, we'll scratch Drew and Mary off the list since we know that they'll be Medicaid or CHIP eligible. Dan is still a household of one for PTC purposes because he files as single. His annual income of $20,000 equals 147% of poverty, making him solidly PTC eligible. For Jen, if she's in a state where she's Medicaid eligible, then she's done. But if she's in a non-expansion state, we'll look at PTC eligibility next. For that, her household size would be three, herself and her two kids as she claims in the tax return. Her annual income is $26,000 or 113% of poverty, which would make her eligible for a PTC. As you can see, there is a mixture of PTC and Medicaid eligibility in the same household, and this is not at all uncommon. The application will help applicants enroll in whichever program that people are eligible for, but it is really helpful to know how the system gets you to that ending point and all of the rules to take into consideration to help make sure that people get to get the correct eligibility determination for their specific circumstances. So with that, I know we are very close to the end of our hour, but I'm going to turn it back over to Hallie to see if we have any questions.
We will just have a couple. One, I want to go back to the very beginning just because, just to reiterate one point. I wanted to clarify that anyone with income, any income over 400% or not, is now eligible for premium tax credits. Is that still true this year?
Right. So the American Rescue Plan Act got rid of that upper bound of 400% of federal poverty as the upper bound for PTC eligibility, but that's not the only criteria. You still have to have an income, or rather, you have to pay more than your required income contribution percentage in order to qualify for a tax credit. So in this case, for folks above 400%, if the benchmark plan where they live for them at the age they are would be more than 8.5% of their income, whatever that income is, then they would qualify for a PTC. But that doesn't mean that any old person with an income over 400% or with any income over 100% of poverty would automatically get a PTC. And we will get into all of the fun math behind calculating PTC amounts next Thursday.
And then one quick clarifying question. For if a person is applying through a state-based exchange site versus healthcare.gov, and is determined eligible for Medicaid, is originally determined eligible for Medicaid, gets sent to the Medicaid agency, is denied by the state Medicaid agency, and needs to go back to the state-based marketplace, do they still get a special enrollment period if open enrollment has ended at that point?
Yes. Although I will say that typically the state-based marketplace's interface with Medicaid tends to be tighter. You could still have issues where this comes up, but it tends to be a tighter interface so that people are not going back and forth to the degree they could be if it was healthcare.gov liaising with a state Medicaid agency.
Perfect. Thank you. And since we're at the hour, again, any questions? I know there were a lot of questions. So if you have a burning question that you'd like answered, please email us at beyondthebasics@cvpp.org. Here are the list of resources from today's webinar. I know you can't click the link, but most of these links are in the chat, but also we will be sending the slides around after the webinar, and they'll also be posted to our Beyond the Basics website as well as this recording. You can also find additional resources on that website and can register for our upcoming webinars. As Jenny said, we have a premium tax credit, an entire hour dedicated to premium tax credits next Thursday, same time. We have immigrant eligibility coming up, plan design, and plan selection strategies. Those are our upcoming ones, but we have 9. This is a 9-part series, so we have lots of webinars and lots of content for you guys. Thank you again for joining us today. Here are the emails of our presenters. And again, that general inquiries email, or you can email questions to. We really appreciate you guys all being here. And we hope to see you next week. And that is all. Let's bring this webinar to a close. Thank you, everyone.